In this video, we are looking at the Accounting Paper 1 exam scope for the grade 12 that will be written on the 14th of November. We are going to go through it using 2024 questions, particularly from the KwaZulu-Natal preparatory exam paper that was written in September 2024. We are going to look at exam strategies, and we are also going to look at how to do some calculations that are known to be quite challenging when it comes to the whole paper. So let's look at the full overview of what our scope is. First, we are your biggest question will be on financial statements, and then the second biggest question that you are going to have on your paper will be the question on cash flow statements, and then you're also going to have interpretation of financial statements, and then also the last question will be on reporting and corporate governance. We are going to go down through each and every one of these topics and break them down to see what you can expect in each, starting with your financial statements. In your financial statements, you can expect three things. The first being the statement of comprehensive income, second being the statement of financial position, and third being notes to financial statements. With statement of comprehensive income, there are some calculations that usually prove to be more challenging, so you need to make sure that you are comfortable with them before you go into the examination. And those calculations include rent, meaning rent income or rent expense. Make sure that you are comfortable with that calculation. And then the calculation of profit and loss on a sale of asset, then the calculation of depreciation with your depreciation methods, and your director's fees. In all over my channel, if you go through my videos, you will find videos, even short clips on how to calculate all of this amounts. And then in the statement of financial position, what can be challenging is trade and other receivables, and it's also trade and other payables and a mortgage loan. When it comes to the notes to financial statements, the notes that you have to focus on, or rather that are common in your papers, would be the fixed asset note, the ordinary share capital note, and the retained income note. Every other note that you could ever have is much simpler than this. So if you can make sure that you master these three, then you will be well prepared for your exam. The calculations to most of these line items are calculated as individual videos in this channel, so make sure you find them and go through them to help you prepare. In question 1, we are looking at a question that is going to help us see how a financial statement question is tested in the paper. You will see that in this paper it was worth 65 marks, and they gave us the information that relates to Old Mill Ltd for the financial year that ended 29 February 2024. Keep that in mind. 1.1 says refer to information B and calculate the following. 1.1.1, the missing amounts denoted A to D in the fixed asset note. So we are looking at our fixed asset note from information B, and we see that we had land and buildings, we had vehicles, and we had equipment, and A wanted us to calculate the additions to land and building. So when you look at the cost to land and building at the beginning of the year, it was 1.1, but then when you look at the cost at the end of the year, at the very bottom, it was 1.9. So it used to be 1.1, now it's 1.9. So basically the addition is the amount that moved it from 1.1 to 1.9. So to find that amount, you simply take the amount at the bottom, which is 1.9 million, and you're going to minus the amount at the beginning, which is 1.1 million, and it gives you 800,000 as your additions, because if you take 1.1 and add 800,000, you get the 1.9 at the end. B wants us to calculate the depreciation for vehicles. Now, when it comes to depreciation, you need to keep in mind that if you have different vehicles, you're going to have to calculate their depreciation individually, and then you have to keep in mind the method that you are using and the depreciation rate that you are using. So in our information, we are seeing that we have vehicle 1, vehicle 2, and vehicle 3. Vehicle 1 had a cost of 500 and an accumulated depreciation of 450. Vehicle 2 had 437 at 500 as cost and 87.5 as accumulated depreciation. And when it comes to vehicle 3, we only have 350 as cost. We do not have accumulated depreciation. They tell us in the bullet following that vehicle 2 was sold for 320 on 1 September 2023. Keep that date in mind. And then in the second bullet they tell us that vehicles are depreciated at 20% on cost. With vehicle 1, we are dealing with a fully depreciated vehicle, and how do you do with it? You just take its cost, you minus its accumulated depreciation, and whatever amount you get, you minus from it 1 rand to say that the vehicle is fully depreciated, but it still physically exists. So you are leaving it the value of 1 rand. So for this one, its value that we can depreciate is 49,999 because we left 1 rand out of the 50,000. For vehicle 2, we take its cost, multiply by 20%, and then we remember that it was sold in September. So we had it from February to September, that's 6 months. That gives us our depreciation at 43,750. Vehicle 3, we were told in the information, was purchased in December, so we take its cost, multiply it by 20%, December to our month end in February, that's 3 months, so that gives us a depreciation of 17,500, and then you add together the depreciations of all of these vehicles, and in the end our depreciation for B is 111,249. And then C wants us to calculate the disposal at carrying value for vehicles. So this would be the disposal of vehicle 2 that was sold. So we want the carrying value of only vehicle 2. The carrying value of only vehicle 2. So vehicle 2, you see there that it had a cost of 437,500 and an accumulated depreciation of 87,500. Then we are also going to minus the depreciation that we just calculated of 43,750. So you're seeing there, we start with the cost for the 437,500 minus 87,500, that's the accumulated depreciation, and then minus the accumulation that we calculated in B, which was 43,750. So if you go look at the depreciation for vehicle 2, it's the same amount. So that gives us the disposal at carrying value of 306,250. My last calculation is D, which is cost at the beginning of the year for equipment. What I'm going to use is the additions of 120 and the 300,000 cost at the end. So what those two amounts are saying to me is that I took the cost at the beginning of the year, I added 120 to it, and it gave me 300 at the end. So to get the cost at the beginning, I just need to reverse those two amounts. So meaning start with the amount at the bottom, which is 300,000, minus from it the 120 that was added, and then that's going to give me the amount to which the 120 was added to for it to end up being 300 in the end. So the amount at the beginning becomes 180, because if you put 180 to the beginning and you add 120, it's going to give you the 300 at the end. Then in 1.1.2, we are calculating profit or loss on the sale of vehicles. So we know that, again, vehicle 2 was the one that was sold, so we need its profit and loss. For profit and loss, we need to know how much it was sold for and how much our carrying value for this vehicle was. So as to how much it was sold for, right under the table they tell us that vehicle 2 was sold for 320,000 cash on 1 September 2023. So we know it was sold for 320. How much was its carrying value? We calculated it in C, and then we knew that it was 306,250. So what you do is simply say for profit, we take the 320 and we minus the 306,250. Where do I get 306,250? It was what we calculated in C in the previous question, and it gives me the profit of 13,750. How do I know that it's profit? Because the amount I sold it for is higher than the amount of its carrying value. In 1.2, they want you to complete the following for the year ended 29 February 2024. They want you to do a statement of comprehensive income, and then in 1.2.2, they want you to do the equity and liability section in the statement of financial position. Now, when it comes to statement of comprehensive income and the statement of financial position, I have done quite a number of videos on them. You can go refer to them. We are not going to redo them again because in those videos I did them in detail. So go look at them. I have one where it's just individually statement of comprehensive income or the income statement, and the one which is the statement of financial position, that is the balance sheet, and one that is actually a mix of both of them. In the topic of cash flow statements, which is your second biggest question in your exam paper, what can you expect under cash flow statements question? You can expect retained income. Retained income is a financial statements note. It belongs to the statement of financial position. However, the retained income has a lot of information that is very relevant to the cash flow statement, so it's not surprising that you will find this note in your cash flow statements. And then you are going to have to be able to calculate your dividend paid, your interest paid, your taxation paid, and then also be able to do sections or parts of your statement of cash flow. They never really ask you to do it in full, so usually it's the financing and investing sections that you have to be comfortable with, and then lastly your financial indicators. So in question 2 there we see that we have a cash flow statement and financial indicators question. It says you are provided with the information related to Doonside Ltd, a public company, for the financial year ended 29 February 2024. Again, it says in 2.1, prepare the retained income note on 29 February 2024. Like we said, this is a very relevant note to cash flow statement, even though it belongs to the statement of financial position. So it's really not surprising that you will find it here. So the first thing that we must do for a retained income note, we are going to look at its framework. What can you expect in the framework of a retained income note? The first line item is the balance at the beginning of the year. Usually that's last year's balance. And then the net profit after tax, and then the shares repurchased, and then dividends. In dividends you are basically adding interim and final, and then lastly the last line item will be the balance at the end. So this would be the retained income at the end of this year. So when we go to our information, we look at our retained income, we see last year's retained income was 386 and 40, and we see that for this current year it's a question mark. So this one for last year will be our balance at the beginning, and that means our balance for this year is what we are going to calculate ourselves. So going back to our framework, we are just going to fill in our balance at the beginning, which is last year's amount of 386 and 40. And then in the next line item, we are looking for a net profit after tax. Be careful because we also have a net profit before tax. What you want is after tax. So let's go to our information, and you see in information A, indeed they gave us the net profit before tax. That's not what we are looking for, but they did give us also the income tax. So to get the net profit after, what you do is take the net profit before and minus the income tax, and it's going to give you the net profit after tax. So in bracket you're going to show it in your framework or in your answer book that 846,540 minus 253,290, it gives me 593,250 as my net profit after tax. And then next I'm looking at shares repurchased. We are told 3,500 shares were repurchased on 1 December 2023, and EFT payments of 22,400 were processed in favor of the relevant shareholders. So keep in mind the 22,400 and the 3.5 shares. And then also what's also important is the number of shares at the end of the year, which is 416,700. Why is it important? Because we are going to use the amount to figure out our average price. So to figure our average price as well, we are going to also have to use the ordinary share capital at the end of our year, which is the 29 February 2024, and we see it there as 2,354,355. So all of these amounts, keep them in mind, all of those amounts, write them on the side. So first we figure out at what price did we purchase each share for. So we take the 22,400 that we received, we divide it by the 3.5 shares that we received, and it says we purchased each share at 6 rands 40 cents. Then we find the average price of our shares. How do we find that? We use that ordinary share capital of 2,354,000. We divide it by the total number of shares at the end of the year, which was 416,700, and it gives us the average price of 565. Now what we want is the price above average. So we take the purchase price minus the average price, and we get the above price of 75 cents. So that's what we are going to calculate our shares repurchased on. So the 3.5 shares multiplied by the amount above average, which is 75 cents, and it gives us 2,625. It has to be in bracket because this is money leaving us. Remember, we were repurchasing, meaning we were paying somebody to give us back our own shares. The next line item is dividends, and the dividends we are looking at interim and final. So in our information E on dividends, it tells us that interim dividend of 40 cents per share was declared and paid to all shares issued on 1 September 2023. So we need to find out how many shares were in issue by that date. And then for final dividend, it says the final dividend was declared on all shares in issue on 29 February 2024. So this is your shareholders for dividend at the end of the year. So for interim, how many shares were in issue? We know that when they issued the interim, it was on the 1st of September, they said. So that was before we repurchased the shares of 3.5. So we are going to take the total of our 416,700 shares at the end, and we are going to add back the 3.5. Why? Because the repurchase is normally subtracted. So we are going to add it back. So for our interim, we had 420,200 shares. So for interim, we're going to say 420,200 shares and multiply it by 40 cents, and it gives us 168,080 for our interim dividend. Then we're also looking for a final dividend to add to our interim so that we can total our dividends. How do I find my final dividend? This is simply your shareholders for dividend at the end of this financial year. So you're going to go to your information and look for final dividend or shareholders for dividends at 29 February 2024, and we see it there as 133,344. That is your final dividend for this year. So final dividend is the same thing as shareholders for dividends. So you take that amount as is, you put it in your final dividend, and then those two amounts, interim and final, when you add them together, they will give you your dividends total. So you add them together and they give you in bracket, because dividends are paid to shareholders, they are going to give you 301,424 in bracket because it's money going out. Then you take your balance at the beginning plus net profit after tax plus shares repurchased minus your dividends, and it gives you 675,241 as the balance at the end of the year, and that's your retained income note complete. And then in 2.2, we need to calculate the following as it would appear in the cash flow statements. That would be our dividend paid and our taxation paid. And then in 2.3, we are also asked to complete the following sections of the cash flow statement, which is the cash flow from investing activities and the net changes in cash and cash equivalents. All of this are found in the two videos that I have compiled for you and posted on the cash flow statement. I have one where it's just cash flow statement and one which is financial indicators added. So what we are going to do, we are going to just skip to the financial indicators, just in case the financial indicators in that video are different from these ones. So our first financial indicator is dividend per share. So we are going to look into our information to find our dividend per share. Our dividend per share, we just need to find our interim and our final. We know that our interim per share was 40 cents. So let's find our final dividend per share. So you're just going to take that shareholders for dividend of 133,344, and you're going to divide it with the amount of shares that were in issue at the end of the year, which was 416,700. So those amounts, when you divide them by each other, they're going to give you the final dividend per share. So the final dividend per share is 32 cents. So for our dividend per share now, you're going to take the 40 cents of the interim and you're going to add it with the 32 cents of the final, and it simply gives you 72 cents as your dividend per share. There is also a different method of doing this calculation, but I feel that this one is the most straightforward and simplest calculation method you can choose to use. And then in 4.2.2 or 2.4.2, you are asked to calculate a debt equity ratio. A debt equity ratio basically looks at your non-current liabilities, and it is non-current liabilities is to ordinary shareholders equity. So non-current liabilities, we see them at 300,000, but our ordinary shareholders equity is a question mark. However, we can calculate it. It's ordinary share capital plus our retained income final that we just calculated in our retained income note. You add them together and you will get your shareholders equity. So non-current liabilities is to shareholders equity. That is our formula. So our non-current liability is 300,000 is to shareholders equity. We take our ordinary share capital plus our retained income, and then we see in the next step that those gives us 3,029,596. We divide both sides by that same number and it gives us 0.1 is to 1. So this is the simplest way you can use to calculate your non-current your debt equity ratio. Remember, with debt equity ratio, on that side we are looking only for non-current liabilities, because some information you will find it given with the current liabilities. So make sure that you are looking at non-current liabilities only. The last financial indicator we are asked to calculate is percentage return on average capital employed. We also have a formula there. It says net income before tax. So our net income before tax, we see it there is 46,540, and then we are also looking for interest on loans. Interest on loans is given as 164,450, and then we are going to find our average shareholders equity and our average non-current liabilities. What do those mean? It just means you take the ordinary shareholders equity of 2023 and of 2024 and you divide them by 2. You add them and divide them by 2. So we now know that of 2024 is 3 million rather, and 29,596. So you're going to add it with that one and divide them by 2, and then average non-current liabilities, that would be our 2023 added to our 2024, and you also divide them by 2. That's what average means. You divide them by 2 or you multiply them by half. It's going to give you the same amount. So let's go do our calculation. So our net income before tax, we know that it's 846,540 plus our interest on loan of 164,450, and then our average shareholders equity, we're saying half of 3,029,596 plus 144,000. That is the amount from 2023. Repeat the same process for non-current liabilities and you put everything in the calculator. It gives you 0 point something. You multiply that amount with 100 and you get a total of 32.1% as your ROCE. Your question paper comes with a formula sheet for your financial indicators. The only problem with it is that it doesn't indicate what each formula is for. So you can use Mind the Gap to learn and study what each formula is for, so that the formula sheet can now be useful for you in the examination room. We then get to the interpretation of financial statements, and what you can expect from here is the financial indicators in this one will be calculated for you for different companies, and what you need to do is be able to interpret them, meaning comment on the financial indicators, talk about what do they mean, and then you're going to have to either compare between two companies or for one company but comparing between two different years. You're also going to have to comment on the financial decisions, meaning you're going to be given some information from the financial statements that will indicate the decisions that were taken, and comment on them, give investment recommendations, and you have to remember your areas of analysis for you to be able to do this successfully. So let's remind ourselves of the areas of analysis. We have already covered them in detail in a video that I have posted on interpreting financial statements and corporate governance for paper 1, so you should go look at it because it looks at the areas of analysis in detail. But here, just to remind ourselves of what they are, we have profitability, we have liquidity, we have return, we have solvency, and then lastly we have risk and gearing. In that video, we go into detail as to what does each and every one of them test and what financial indicators are able to tell you about each and every single one of these areas of analysis. So when they say comment on the profitability of this company, you know which financial indicators you need to be talking about. So let's look at a question in our question 3 of that same KwaZulu-Natal paper for the 2024 preparatory examination. We see that you are presented with financial information of two companies. We have Umzinyati Ltd and Ilembe Ltd operating in the same industry of a similar size for the year ended 29 February 2024. Note: provide figures, trends, financial indicators, or calculations in each case to support your comment and explanation. 3.1 profitability. It says quote and explain two financial indicators to show which company is managing its expenses more efficiently and is thereby more profitable. So that means I'm going to look for the financial indicators that fall under profitability and talk about those for the two companies. So the profitability indicators that I want to talk about are a percentage operating expenses on sale and the percentage operating profit on sales, so meaning the first two. So we see that for Umzinyati it used to be 13.4, it moved to 15.6. For Ilembe it used to be 18.2, then it went down to 14.9, but this is expenses, so expenses we want them to go down, Vela. So that means Ilembe is doing good in this regard. And then when it comes to profit, we want profit to go up. For Umzinyati it used to be 19.8, but now it's 17.8, and then for Ilembe it used to be 22, now it's 24. So Ilembe is the one that went up, so that's the one that is preferable. So the company that's doing well is Ilembe Ltd because their percentage of operating expenses decreased from 18.2 to 14.2 by 3.3 points, and their operating profit increased from 22 to 24 by 2. To show financial figures just simply means to state what the amount used to be and what it is now and what is the difference. Then in 3.2.1 we are looking at the returns area of analysis, and it says comment on the percentage return on shareholders equity for each company. So we are going to go to our information and we are going to, they have given us the specific financial indicator to look at, that is the return on shareholders equity. So we are going to look at that one. For Umzinyati it used to be 13.4 and now it's 9.4. For Ilembe it used to be 17.8, now it's, no, it used to be 13, now it's 15. So when it comes to percentage return, we want to know that is it bigger than our alternative investment. Our alternative investment is at 10% for both of them when we are looking at this year. So that means if they invest elsewhere, they will get a 10% return. So when you look at Umzinyati, this year they are getting 9.4 when they could be getting 10%. So it's lower by 0.6. And then when we look at Ilembe, it is 15, which is above the alternative investment by 5%, because that is 5 minus 10, and it's a difference of 5%. So that means that you are getting a better return if you invest at Ilembe, because Ilembe is going to give you what is more than other alternative investments out there, other than Umzinyati, who gives you 0.6 less than what you can get out there with other investments. 3.2.2 says a shareholder feels that earnings per share in Umzinyati Ltd are better than the Ilembe Ltd. Explain by quoting one financial indicator or calculation why you agree with him. So they are already telling us that we are supposed to agree that Umzinyati is doing better. So we are just looking for indicators that will justify that Umzinyati is actually doing better. So the simplest indicator to look at, since we are talking about earnings per share, let's just look at the earnings per share of both. So for Ilembe, it used to be 65 cents, now it's 72. For Umzinyati, it used to be 80 cents, now it's 138. So the difference there is that Ilembe has increased by only 7 cents from 65 to 72, whereas Umzinyati has increased by 58 cents, because it used to be 80, now it's 138, and that's why it's doing better, because it has a higher increase. So your explanation will be their EPS increased by 58 cents, which is a 72% increase. How did I get 72% increase? I said 58 divided by 80 cents, meaning the difference minus divide by what it used to be last year. That gives me 0.72. I multiply that by 100 to turn it into a percentage, and that's how I got that 72%. So show your calculations in brackets always. There's usually a mark for them. Shifting gears to 3.4, we are asked to refer to information C and comment on the price paid for shares repurchased by Umzinyati Ltd. So we are no longer looking at interpreting financial indicators, but some information of a shareholder. You will see in information C, we have a shareholder who's called Happiness. He has invested in 2 companies. In these 2 companies we are dealing with, Umzinyati has repurchase shares from Happiness for 17 rands 50 per share, and this is the amount of share price that we are asked to comment on. So when you look at the market price of the shares of Umzinyati, they are worth 1,200 cents. When you take that amount and divide it by 100, it's going to give you 12 rands. So the shares, the market value of the shares are 12 rands. We paid 17 rands 50 to get them back. So the answer here is the repurchase price of 17 rands 50 is higher than the market price of 12 rands. I show in bracket how I got the 12 rands is the 1.2 divided by 100 by 500 and by 5 rands and 50 cents. They only said comment on them. They didn't say give an opinion or whether if this is good or bad. Just state what just happened here. It is, we paid 17 for something that is only 12 rands. And then in 3.4.2 it says calculate the number of shares that Happiness purchased in Ilembe Ltd's with the money he received from Umzinyati Ltd. Note, she used 51,800 to pay for her son's school fees. So we need to know, remember, Umzinyati gave her money to buy back their shares. So out of that money, she used it to buy shares now in Ilembe. So how much was the total? We know the price per share was 1750, but the total she received for however amount of shares that they were buying was 2,625,000, and then he bought additional shares at Ilembe for 14 rands per share. So he used that amount to buy the amount at Ilembe for 14 rands per share. So out of the 2,625, we know that 51,800 was used to pay for her son's school fees. So we will minus that amount, and we are left with 2,500,000 573,200, and we divide it by 14. Why 14? That is the price per share of buying at Ilembe, and that's going to give us 183,800 shares from Ilembe. Remember, what we were calculating was the number of shares she could purchase with the money she got in Ilembe. In 3.4.3, it says explain the effect of shares repurchased and the new shares purchased on the percentage holding of happiness in each company. Provide the relevant calculations to substantiate. So basically, when you are asked about the percentage holding, the only thing you are interested in is a person a majority shareholder or not, and how closer is it to that position. So majority shareholding, we know that it is 51%. That makes you the majority shareholder. So when we look at the shares owned, we now know that she owns 309 in Umnyati, and then in Ilambe she owns 540,800. How did we get it? Is the 183 plus the amount for 2023, which is 357. That gives us 540 that you see there. So we comment on both companies. Starting with Umzinyati, Happiness used to be the majority shareholder, but now she only holds 41.2%. How did I get it? Is how much she owns this year and how much Umzinyati has in issue. You divide those two amounts together. Then Ilembe, Happiness used to hold 42%, so that's last year's amount divided by last year's shares in issue. But now she holds 52%, which makes her the majority shareholder. How did I get 52%? It's the amount she owns this year, which is the 540,800, divided by the number of shares in issue in Ilembe in 2024, and those are 1,040,000. So that gives me 52%. The last topic is the reporting and corporate governance topic, and what you can expect under this one is the reporting and governance concept, meaning what are some of the concepts and terms that you find under this topic. You need to be able to explain them in case you have a matching column type of question, or you have a filling the answer type of question. You have to be able to comment on directors' decisions, so they will tell you about some decisions that were made by the board of directors. You have to be able to talk about it. You have to be able to comment on the audit report. You have to remember your GAAP principles, and you also have to comment and give advice on fraud and misconduct that can be identified in some of the scenarios that will be given to you in your information. So let's look at a question to see this question in a question paper. In 4.1, they said choose the correct term from column B and match it to column A. So in column A we have descriptions, and in column B we have some reporting and governance concepts. So 4.1.1 says guidelines for the preparation of financial statements to ensure consistency. What do we call this? We call this the International Financing Reporting Standard, that is the IFRS. And then in 4.1.2 it says it sets out the rights, duties and responsibilities of shareholders and directors. So what does this for us is what we call the memorandum of incorporation. So when a business starts, it gets what we call a memorandum of incorporation, and it sets out those rules for us. In 4.1.3 it says the total number of shares that the company can issue. If you remember your ordinary share capital note, you will know that this is called the authorized shares. So the answer to this will be D, authorized share capital. And then in 4.1.4 it says the financial matters must be reported conservatively. This is GAAP principles. It's the GAAP principle of prudence. You will see in column B we have two GAAP principles. The other one is going concern. Going concern means it must be reported on an ongoing process. So this one is prudence because it's talking about reporting conservatively. And then in 4.2 we have Lutuli Limited. The information relates to the financial year ended 29 February 2024. Msizi Khumalo is the CEO and the director of the company and is the majority shareholder. There are two other directors. We can already see a problem there. When somebody has too much power like that, you know that we are going to find some problems. Then 4.1.2, it says refer to information B. What is meant by good corporate governance and why is it important to shareholders? So in information B, it says White Limited is a respected company with a good reputation for good corporate governance. They have made an offer to purchase the remaining 2,550,000 shares in Lutuli Limited at the price which is considerably more than the current market value. So, what is good corporate governance and why is it important to the shareholders? So, first, good corporate governance means to ensure that the business is managed in an ethical manner following the proper rules and policies, meaning nobody is taking advantage, there's no bias, and everything is in order, meaning less fraud, right? And then why is it important to shareholders? It is important because good corporate governance has an impact on the image of the business and the value of its shares. So when the business has a good image, usually that drives up the price of its shares. So if the company has bad corporate governance, meaning there is fraud in that company and things don't run properly, it will affect the image of the business, which will also affect the price of the shares. And that's why it's important. So in 4.2.2, it says explain a possible reason why Msizi Khumalo says he will vote against the proposal by White Ltd. So remember in information D, we were told that White Ltd is another company that's trying to buy shares in us. So let's start our information from information A so we can get the full story. It says Lutuli Limited has recorded declining profits in the past few years. The cash flow has deteriorated and the company has relied heavily on securing loans at very high interest rates to manage daily operations. So you can see that they're doing bad. And then we have a solution in B, that is the story of the White Limited trying to buy the remaining 2.5 million shares, and they are going to buy them at a considerably higher price. But then in information C, we hear that Msizi Khumalo says that he will vote against this proposal. The other directors feel strongly that this offer is very generous. They are in favor of accepting the offer. So the situation that we have here is the company is doing bad. Here comes another company that has a very good corporate governance, and our CEO is saying no. Why would the CEO say no to another company trying to give us a solution, and this is a company that has good corporate governance? So the reasons might be that he's afraid that he will lose his majority shareholding, because remember, he's the majority shareholder as well. He's not only the CEO. The second other possible reason could be he might be investigated for fraud, because if another company is coming in and this is a company with good corporate governance, he's probably afraid that it will blow his cover and he will be investigated for fraud and negligence. You were just to give one answer. I just gave you two options just for in case. And then in 4.2.3, it says the other directors feel that Msizi Khumalo is abusing his position as CEO and majority shareholder. Explain why you agree with them. Provide 1 point. And then also in bullet number 2, give the directors advice on how they should handle this. Give 1 point. So we agree with the shareholders because he is making decisions that only benefit him. So he's trying to protect his position, not thinking about the well-being of the company itself. What should they do? They should issue him a grievance report or ask him to step down as the CEO or as the majority shareholder. He should at least not hold one of these positions since he's not making good decisions for the company's well-being. If you have YouTube recommend you more of my videos, be sure to click the like button and subscribe to the channel. And if you have any questions, leave them in the comment section below.